This is Mark to Market, a podcast of BT Correspondents.
Hello everybody, welcome to Mark to Market, a BT Correspondents podcast that aims to provide analysis and insight on market trends and corporate issues in Singapore. My name is benpaul and I'm a senior correspondent at the Business Times. Every week, my colleagues and I delve into a business story that matters. We're in the month of December 2024, and one company that's been in the news a lot recently is DBS, the largest of Singapore's three local banks and the largest company listed in the Singapore market. About a month ago, on the morning of the 7th of November, DBS reported its third quarter results. It was another set of strong financial numbers. Net profit for the quarter hit a new record, driven by balance sheet growth as well as strong fee income. And reflecting that strong performance, DBS said it would pay a third quarter interim dividend of 54 cents per share, which brought its total dividend for the first 9 months of the year to $1.62 per share. On top of that, DBS announced a $3 billion share buyback program. Not surprisingly, DBS shares immediately jumped. The stock closed 6.5% higher on that day, which is quite a lot for such a big company. The following day, on the 8th of November, the stock climbed a further 1.7%. Now, here's the thing. The following week, a filing by DBS showed that its CEO, Piyush Gupta, had been unloading shares in the market during those 2 days, effectively benefiting from the strong rally that had been triggered, at least partly, by the share buyback announcement. Over those 2 days, a total of 300,000 shares in which he held a beneficial interest were sold for a total of $12.6 million. This was not a good look for DBS and its CEO. Share buybacks are often taken as a signal from a company's board and management that its business is thriving and that its share price might be too low. Yet one could argue that the sale of shares by a company's CEO sends the opposite message. So in this podcast, I'm going to dive into the topic of share buybacks and some of the broad issues around executive compensation practices and try to propose ideas to improve things from the perspective of investors. And I hope this will inspire other people to weigh in with proposals of their own. Let me start with some context on what happened. First of all, I should point out that DBS was not the only bank stock that rallied recently. Its peers, OCBC and UOB, also shot up after reporting strong third quarter financial numbers and commenting about their own capital management plans. DBS, OCBC and UOB are also the three biggest components of the Straits Times Index, and their rally came amid an upward surge in global investor sentiment following Donald Trump's election victory in the United States. President-elect Trump is expected to pursue a range of policies that may stoke inflation and slow the pace of rate cuts by the US Federal Reserve, which could be positive for net interest margins of the three banks. So, the backdrop of this whole episode was a very bullish market. The other thing that's worth highlighting is that folks like Piyush Gupta, CEOs of public listed companies, receive a large portion of their total compensation in the form of shares, and they're restricted to selling those shares only within certain windows. So the point I'm making here is that CEOs are going to sell their shares from time to time because it's sort of like cashing their paycheck. And those sales, when they happen, may not necessarily reflect any bearishness on their part about the companies they're running. My purpose in offering this context is not to explain away what happened, but to avoid getting sidetracked by the less relevant issues. If it's not wrong for CEOs of public listed companies to sell their shares and profit handsomely when they do, and that their share sales may not reflect any bearishness on their part about the outlook for the company, then what's the problem? If the problem was just the timing of the sale of shares by the CEO of DBS, that he sold some of his shares on the very same day the bank made some very positive announcements, then I think most people would agree that we just need some rules around that issue. Maybe directors and CEOs of public listed companies should not be allowed to trade their shares on the same week of a big announcement. Maybe we should look at how it's done in more developed markets and adopt their best practices. These are the sorts of things that corporate governance consultants and experts love to get into, and it may be helpful to explore some of these ideas. But as an investor, I'm more interested in the fundamental issues. For example, do share-based compensation schemes properly incentivize and motivate senior executives and directors to act in the long-term interest of the companies they run? I think most investors like the idea of CEOs having significant exposure to the shares of their companies. But if such a large portion of a CEO's total compensation is in the form of shares, such that the CEO is constantly a seller of those shares, then is it possible the CEO may from time to time adopt strategies to boost the company's share price in the short term instead of only focusing on the company's long-term profitability? And is the CEO likely to become more inclined to think short-term when he's preparing to retire or make an exit? Now, I'll come back to this point later in this podcast, but let me first get into the topic of share buybacks as a means of returning excess capital to investors. Unlike dividend payouts, share buybacks only return cash to shareholders who choose to exit. Shareholders who hold on to their shares ostensibly stand to benefit from an increased share of the company's future earnings. But here's the problem. Companies conducting share buybacks rarely explain how they determined that continuing shareholders are obtaining the increased share of those future earnings at an attractive price. They usually do not offer a view on what the intrinsic value of their shares might be. So how can those companies know whether returning capital through share buybacks is in the interest of their continuing shareholders? To make matters worse, companies tend to have the inclination and financial capacity to pursue share buybacks only after a period of strong financial performance, when their share prices might already be elevated. Investors tend to overlook the risk that a cyclical downturn might be around the corner and forget that it's actually not a bad thing for companies to have some excess capital on their books when the macroeconomic picture turns sour, because it's hard for companies to raise funds when their profitability dips. In the case of DBS, its shares have been hitting new highs on the back of record earnings as interest rates rose over the past couple of years. But this tailwind of rising interest rates is now waning. Earlier this year, DBS indicated that it's targeting a return on equity of between 15% and 17% going forward, which is lower than its current ROE of 18.8%. So why do public listed companies in Singapore choose to do share buybacks instead of just paying higher dividends? What can be done to resolve the tension between continuing shareholders and exiting shareholders during a share buyback? I'm going to talk about that next.
If you've been a fan of the podcast Mark to Market, Wealth BT and Property BT, they are moving to a new listing, BT Correspondence. Look for episodes every Tuesday from October. All the insights and analysis and market trends, property, wealth, and soon mobility too. Powered by the Business Times journalism of Genevieve Kwa, Leslie Yee, benpaul, and Darren Wong. Because great reads should be heard. The BT Correspondence channel. Find BT Correspondence wherever you listen to podcasts.
And now, back to Mark to Market, a podcast of BT Correspondence.
This is not the first time I've delved into the topic of share buybacks. I have written about it a number of times in the Mark to Market column, and I also talked about it in episode 28 of the Mark to Market podcast series. The reaction I often get, including from some investors, is that I'm wrong to suggest that companies should not do share buybacks when their shares are trading above their intrinsic value. The view held by many people is that share buybacks are fine at any price because it's simply about returning excess capital to investors. Whether a company's shares are undervalued or overvalued, a return of capital is achieved when it buys back its shares. And the company's share count is also reduced in the process, which leaves continuing shareholders entitled to a larger share of the company's future earnings. So, where's the harm? Well, I guess one could argue that there would be no harm if the company's earnings grew strongly after the share buyback exercise and the market value of its shares eventually climbed well above the price at which it bought back its shares. You could apply the same argument when a company makes an acquisition. There would be no problem with the company paying a very high price if the acquisition target subsequently performs very well. But that would only happen if the company had correctly judged the future performance of the acquisition target, or, in other words, that the company had accurately determined the intrinsic value of the acquisition target, and avoided paying more than that intrinsic value. Now, to be clear, I'm not saying that companies should never do share buybacks. I'm only saying that if companies are going to buy back their shares from some shareholders but not others, then they should be certain that they're doing so on terms that make sense from the perspective of continuing shareholders. And share buybacks can be done in a more transparent and inclusive manner. Earlier this year, property company OUE unveiled an equal access off-market share buyback. Under the deal, shareholders of OUE had the option, but not the obligation, to sell up to 10% of their shares back to the company at $1.25 per share. The shareholders were allowed to tender shares in excess of 10% of their holdings if other shareholders did not accept their full entitlements. This deal was fair to all shareholders, in my view, and it also made a lot of sense. Like many property companies, OUE was getting a very poor valuation in the market. The off-market buyback price was more than 70% below OUE's net asset value at the time, but it was a 20% premium to the stock's average closing price over the 5 trading days preceding the date of the share buyback announcement. So the deal enabled all shareholders of OUE to monetize a portion of their shares for more than they could otherwise have obtained in the market. Now, this off-market share buyback has not helped OUE garner a better market valuation. Its share price has actually fallen back down to roughly where it was before the buyback announcement. But the question of whether OUE overpaid for its own shares did not arise because of the equal access nature of the transaction. All OUE shareholders had the opportunity to decide whether to accept the buyback. So why is returning capital through these sorts of equal access off-market share buybacks not more popular? Why do most companies prefer on-market share buybacks? Let me first point out that on-market share buybacks are often not about returning excess capital to shareholders. Many major Singapore-listed companies use their share buyback mandates only to support the vesting of awards under their share-based remuneration schemes. In fact, DBS said when it announced its $3 billion share buyback that this is the first time it is repurchasing shares with the intention of cancelling them, and that this program is over and above the share buybacks it periodically carries out for the purpose of vesting employee share plans. Of course, having a share buyback mandate enables companies to act opportunistically in the market when their share prices tumble. For example, share buybacks in the local market surged dramatically during the pandemic turmoil in March 2020. So, my sense is that Singapore-listed companies seek share buyback mandates simply to have some ability to respond to swings in their share prices. Returning excess capital to shareholders is often not the main objective. And that's why companies prefer on-market share buybacks over off-market share buybacks. It enables them to opportunistically participate in the trading of their own shares. As an investor, I don't particularly like the idea of companies meddling with their own share prices. I would much rather companies focus on building up their businesses and address the return of any excess capital in a consistent and deliberate manner. As far as possible, they should leave the pricing of their shares to the market. So, what can be done to improve things from the perspective of investors? One suggestion that I've made in the past is that companies seeking share buyback mandates be required to provide an estimate of the intrinsic value of their shares and state the valuation below which buying back their shares would be in the interest of continuing shareholders. No doubt, some shareholders of the company may have very different views on the right price at which to pursue a share buyback program. Nevertheless, a clear statement from the company's board on the matter would make it accountable to its shareholders and provide the market with a useful guidepost on how to price the company's shares. Companies who feel unable to provide an estimate of the intrinsic value of their shares should perhaps just stick to returning any excess capital to their shareholders through special dividends, or perhaps through periodic equal access off-market share buybacks. What about companies that want to carry out on-market share buybacks for the purpose of vesting employee share plans? As I mentioned earlier, perhaps there should be rules to ensure share buyback mandates for this purpose are not abused by corporate insiders. For instance, perhaps directors and senior managers should be prohibited from selling any shares until their company's share buyback program is safely over. But perhaps it's also time to rethink the whole idea of share-based compensation and look closely at whether this form of compensation is motivating top executives to behave in a manner aligned with the long-term interests of investors. Perhaps these share-based compensation schemes could be tweaked such that the recipient of the awards are paid in cash and told to acquire the shares from the market themselves over a certain period of time. It would be far more interesting for investors to know the details of a CEO's share purchases than his share sales. Now, these are obviously not specific proposals that can be implemented immediately, but conceptual solutions which I hope will spark a broader debate on the issues around capital management, share buybacks, and share-based compensation practices. With changing economic and market conditions, companies should ensure their policies on these crucial matters are still fit for purpose. That's it for this edition of Mark to Market. BT Correspondents will be back next week with wealth editor Genevieve Kwa, so please keep listening. In case you haven't heard, Mark to Market is now part of the BT Correspondents channel. That's where we'll be posting our episodes from now on. Go follow BT Correspondents so you don't miss out. If you have any thoughts or questions about the show, email us btpodcasts@sph.com.sg. I'm Ben Paul. As always, thank you for listening and join us again next week.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.